Yo guys, what is going on? Welcome back to the channel. Boys, I'm excited because today is going to be a crazy video about liquidity. Liquidity is one of the most important things, if not probably the most important thing in trading, because if you don't understand liquidity, you're not going to know where the market's going. You're not going to know how to catch a trade. You're not going to know anything about higher time frame if you don't understand liquidity. So liquidity is the start of your trading expertise, and in today's video I'm going to be explaining liquidity. And the reason I know liquidity is such an important concept is because it's what I've used to go from zero to over $500,000 in funding in less than a year of trading. And you guys can literally do the exact same if you follow what I'm going to tell you in this video. Make sure to watch to the very end, okay? Don't skip it. Don't be a lazy guy and try and cut to the important parts, because every part is important. If you miss 1 second of this video, your life is going to be over. So seriously, I'm joking, but watch the whole thing because you're not going to learn if you don't. So without further ado, let's get into the video. And by the way, if you are wanting to watch me trade live every single day in my community and have access to 3 separate courses teaching you in loads of detail how to trade, then press the first link below. But let's get right into the charts and I'll show you how to understand liquidity. Let's go. Alright guys, so looking at the charts right here, I'm going to show you a really basic example of liquidity, okay? We've got our student Bruno in the top, as you can see there.
Yeah. School's in session, boys.
Let's go. He's learning with me, and so far he's gone over, the basics like candlesticks. We've done some discipline, we've done some trends, we've done some change of characters and break structures, which you guys can all check out in the previous videos, okay? But this one's going to be on liquidity, right? Now, liquidity basically refers to where the orders are placed in the market, okay? Because orders are obviously going to be placed in the market as that's where people are buying, right? When people buy, that means there's an order. Basically, liquidity is where people are buying or selling from, okay? So that's the simplest way to put it. Now, this example right here, okay, shows you an example where we have some sort of like resistance level here, okay? And the only thing you need to understand is that it's clear that, when price comes into here, people are selling. When it comes back into here, people are selling. When it comes back into here, people are selling, right? And it's because you can see there's some sort of resistance holding people back, and holding the market back from going up, right? And every time it comes into here, it keeps on selling off. Now, what this is basically doing is building up liquidity, because as I said, liquidity is basically a build up of orders, okay? Now, because the market is always selling off from this area, there is going to be loads of orders above this area, okay? Because when people sell from here, what they're going to do is they're going to have their stop losses above this area, right? As they're not expecting it to go higher. So the stop loss might be something like this, okay? And the same thing for here. When they sell here, the stop loss will be above the high, maybe something like this. And the same thing goes for here, okay? And it's because there are orders at this level. Now, what liquidity basically states is that because the market knows there's orders at this level, it's very, very likely that it's going to go and take out these orders, stop out all of the people that were selling from here and here and here, take this liquidity resting above all of these highs here, and then go lower.
So when price rises and hits that point of liquidity, what does it mean? Do all those orders just shut so it drops lower? Is that why?
Yeah, basically, bro. So what happens is when price comes up here, it obviously hits all of these people's stop losses that were selling from here and here and here. Those orders are now all closed, okay? And there's basically enough fuel in the market to move down. That's the best way of thinking about it, right? When these orders are all closed,
people were already expecting it to drop anyway, but they didn't expect it to go higher, so it pushed through their SL or their stop loss.
Yeah, so all of these people were selling here, okay? They didn't expect it to go higher, so yeah, the stop losses were above the high, right? But then price came up, stopped them out, and now there's enough orders that have just been taken out to now fuel the move down, because basically liquidity has been taken from these highs here, and all of these people that were selling here, those orders are now closed. So now the actual move can happen, right? And the big move that happens here is what the banks normally do. The banks normally are going to stop out the retail traders. That's what all of these people here are called. They're called retail traders, as they're selling at very obvious points. Then the bank is going to manipulate price higher, taking out this liquidity, taking out these orders, stopping these people out, and then the move down is going to happen. Okay, so that is what
So
liquidity means.
are the traders that put that order once it hits that average peak, you see the three peaks, are they bad traders? Are they just taking advantage of that, or is it you can expect the market to normally just do the same thing?
Yeah, so these guys right here would be pretty bad traders, right? Because, like, yeah, essentially, they are selling at a resistance level, okay? And there's obviously things called support and resistance in trading, but like I said, there's retail traders, and retail traders tend to just do those very basic things. They don't really tend to understand the more advanced things, and that's why they continuously just sell at these resistance levels, but they don't have a good understanding that they're just being used as liquidity. And then me, a smart money trader, is going to be entering the market here after that liquidity has been taken out. Okay, now I don't really want to get into too much detail on how to enter after liquidity has been swept. I'll make a separate video on this, but yeah, essentially you've got two types of people. You have person A who's selling at, you know, a very clear resistance level where there's obviously, you know, some sort of sells, but it's already been reacted to multiple times. Okay, and they don't really understand that this is just building up liquidity so that the market's going to take it out and then fuel the actual move to the downside. Okay,
Mm-hmm.
that's what this is happening. That's what's going on right here. Basically, whenever I'm explaining this, and even in my head, I think of it as just literally, does the market have enough fuel to go in the opposite direction? Okay, and it doesn't until it takes out all of the orders resting above this high. Then it takes it out, and then it's basically giving fuel into the market to see a move down. Okay, that is the most simple way of explaining it. And you want to try and make trading simple, right? You don't want to overcomplicate liquidity. Literally, just think of it as, you know, liquidity is always above highs and below lows. Okay, so for example, the same exact thing can be shown for the opposite end of the spectrum, right? So there's going to be, of course, liquidity resting below this point as well, right? Because as you can see here, the market is clearly reacting and bouncing off this line right here multiple times, multiple reactions from it. Okay, and as a result, there's going to be lots of liquidity resting below these lows here, just like how we had liquidity resting above these highs here. So what we can do is we can basically predict that the market isn't going to see the move from here. What the market's going to do is come down first, take out all of these guys that are buying from here, sweep this liquidity, stop out all of these traders who are buying, and then see the move up. Basically, it's the inverse of what I just said before. Okay, it's just in a scenario where the stop losses are now from people buying instead of selling. Okay, so everyone that's buying here would be stopped out. There's now enough fuel to move the market up, as all of these guys have been stopped out. Liquidity's been taken, and now the move up can happen. Okay, and obviously as traders, we want to avoid buying here where we know we're going to be used as liquidity, because we're buying from a very obvious point. Okay, we want to be buying here after all of these retail traders have been taken out of the market. Okay, alright guys, so that was just the first example of liquidity right here. Now I'm going to show you some more examples, and by the way, I'm not actually going to go into the charts in this video. I'm just literally going to show you examples, and in the part 2, which I'll be making in a couple of days time, that's when I'll go on the charts and show you exactly how to find these examples on the charts. Okay, so another example of liquidity can literally just be, you know, let's just draw out some random patterns. Okay, and what I'll be able to do is show you that there's liquidity always above highs and below lows. Okay, now like you guys just saw, this is a completely random pattern which I literally just drew out. Okay, now there's really been no thought that goes into it, but what I'm going to do is I'm going to mark out the fact that there's liquidity below lows and above highs. Okay, so for example right here, this low, the first low that I'm showing you guys on my charts right here, there's going to be liquidity resting below it. Okay, now the reason why there's liquidity resting below lows is for the exact same reason that there's liquidity resting below these lows here. Okay, the market knows that people have been buying at this point right here. The stop losses are below this low. Okay, and as a result, the market tends to go and take out these lows before the actual move happens, or before a reversal happens of some sorts. So there's liquidity here, the market comes down and it takes it out. Okay, now the same thing can go for example, this high right here, right? There's liquidity resting above these highs here, And basically every single high and low is going to have liquidity resting above it or below it.
Right.
Okay, that is the most simple way to put it. Every single high and low is going to have liquidity. Now there's going to be some highs and lows that have more liquidity than others, which I'll get onto in a second, but every single thing is going to have liquidity, right? There's liquidity above these highs here. There's liquidity above these highs right here, right? There's liquidity above every single high and low in the market, and anyone who tells you otherwise is wrong, right? There is always going to be some level of liquidity above highs and lows. Now, as traders, we can use this to advantage, because let's say we're looking to take a trade. What we can do is we can understand that there might be liquidity below these lows right here, okay? So there's liquidity below these lows. There's liquidity below this low as well right here, right? And like I said in the first example, we need to see these lows taken out so that we take out liquidity from the market to fuel a move in the opposite direction. So let's imagine right now that for this day right here, our bias was bullish, right? What we would want to do before we take a trade is see these lows taken out, right? Grab liquidity from these lows here, grab liquidity from these lows here, and then take the trade in the direction we want it to go in, right? That is the essence of liquidity, is you trade with your higher time frame bias and you wait for lows or highs to be taken, and that means liquidity has been taken from the market, and now the reversal is going to happen. So this is an example of a trade which I would take. You know, we see a big sweep of liquidity from these lows here, right? So this low right here, hold up, from this low right here, okay, and then also from this low right here. Then we see it taken out. All of the guys that were buying at this level right here have been stopped out. All of the guys buying here have been stopped out. And then the market's fueled its move to the upside. To go where, right? It goes to take out the next point of liquidity, which would be above this high, right? So not only can you use liquidity to take trades from, but you can also target levels of liquidity as well. So going back to this example right here, right? We wait for price to take out this liquidity here, this liquidity here. Then you would take a buy. Now that we've taken out a lot of liquidity in the market, your stop loss is always going to be below the low, right? And your target can be the next point of liquidity, which is this high right here, okay? This is the closest high to where we took the trade. So this would be our target, right? And as you can see, price is going to go to it because there's liquidity above highs, right? So that is what you would do in the market, is you would wait to take a trade after a high or a low has been swept. There's now been liquidity taken out of the market, and now there's enough fuel to actually see the move, okay? So this is what you would look for, right? You always wait to see a high or low taken out. That is a sweep of liquidity, and then basically the market's going to move in its intended direction, okay? What you would not do is you would not be trading like at a random point, let's say right here, right? Because there's still these lows here, right? There's still this point of liquidity that it's likely that the market's going to go to before it moves up. So why would you buy here when you know that there's liquidity below this low? What you would do is you would wait for it to be taken out and then take a trade, okay? Or if you want the best scenario, you wait for both of these liquidity points to be taken out and then take the trade. But the point is, you want to wait for the liquidity to be taken out of the market before you trade, because without a sweep of liquidity, there is no fuel to move in the opposite direction, okay? Just like we saw here in example number 1, there needs to be a sweep of liquidity before there's a move in the other direction. And the same thing goes for a more advanced example like this. We need to see a liquidity sweep before we see any sort of entry, okay? So yeah, bro, does that make sense?
Yeah, it makes sense. I feel like it adds another layer now to my trading knowledge, because it's almost a contradiction to your standard change of character or something.
Yeah.
You actually, other things are in play that are going to affect the next move. You know what I mean?
Yeah, 100%. 100%.
But that's good. Yeah.
Yeah, like, you know, about change of characters and everything as well. There are going to be times where, well, this is another thing which I'm actually going to cover. Maybe I might have to do like a 3-part series for this liquidity, okay? But what you would do is, instead of just taking a trade now from every single change of character, what you would want to do is take a trade. Actually, I can use this as an example. Take a trade after you sweep liquidity and then see the change of character, right? So, for example, let's say we take out this liquidity here and then we see a change of character after we've taken it out, right? This change of character is now going to be 10 times stronger than a change of character that might have happened up here before we saw a sweep of liquidity. Does that make sense?
Right.
Yeah. So this is when we can start to pair up confluences together. So now we're pairing up liquidity sweeps with change of characters, and that strengthens your trade. Okay. So now we're not just trading purely based off every change of character. We are now combining the change of character with a liquidity sweep, like we've just seen right here, and then you take the trade. Okay. And that is how you're going to become a really good trader, is by pairing up multiple different things. Okay. Now there's a few more examples of liquidity I want to quickly cover. Okay. But you know, that is a really good example, and it's good you mentioned that, of how you can actually trade with liquidity. You would never just take a random trade. You would wait to see a confirmation on the lower time frame after we swept liquidity, and then you trade. Okay. Alright guys, now the next thing I want to cover is going to be liquidity from different sessions in the market. This is something which I haven't actually covered, and for those of you who are complete beginners, you might not even know that there is different sessions in the market. So very quickly, there are 3 different main sessions in the market: Asian session, London session, and New York session. Now I'm going to get into a more detailed video on these sessions, the timings of them, and exactly how to trade them in a future video. But for now, just understand that there are 3 different main sessions in the market, okay? And there's going to be liquidity above the highs of the session and below the lows of the session, okay? Just like how we had right here, liquidity below the lows and above the highs. Just like how we had right here, liquidity below the lows and above the highs. The same thing goes for our sessions, okay? Because in each session, there is going to be a high and low of the session, okay? So for example, Asian session tends to consolidate. So let's imagine that Asian session looks something like this, okay? The high of Asian session is right here, okay? If we just draw it out like this, this is the high. And the low of Asian session, let's actually make it a bit more realistic. Let's just say it is like down here, okay? Something like this, right? Because Asian session is going to consolidate mainly, but there are going to be clear highs and lows. So this can be the low down here of Asian session, okay? Now, just like I said before, guys, okay, there is always going to be liquidity above highs and below lows. So what we can expect the market to do is head towards the Asian session highs and Asian session lows, as there's liquidity below and above them, okay? So what we can do is we can expect the market to, you know, maybe move around in this area, but ultimately it is going to head for either the Asian low, which is down here, or the Asian high, which is up here. And just like we did before, right, when this liquidity has been taken out, that now gives us a reason to take a trade, okay? Because we've taken out all of the liquidity below Asian low, okay, now the market has enough fuel to go into the opposite direction. And that is exactly what we're seeing right here. Now, this move to the upside is going to happen in London session, okay? London session, which is the session after Asian session, which starts at around 8 AM, okay? This tends to take out Asian low or Asian high and then go in the opposite direction. Now, this is all going to be explained in another video, so I don't really want to go into detail on this, but the only thing I want you guys to understand so far is that, you know, let's forget London session. It's literally just that. Sessions, so i.e. Asian session in this example, has liquidity above and below the highs and lows, okay? And just like in the previous example, just like this one right here, okay, liquidity is going to go to these points where the market has highs and lows. It's going to take it out, and then when it takes it out, it's going to see the move in the opposite direction. And just like Bruno said before, when it takes it out, that is when you look for your change of character, and that's when you can possibly catch a trade in the other direction, okay? So just one more time, guys. Asian session, which by the way is at 1 AM, finishes at 6 AM UK time, okay? So Asian session has highs and lows, right? The market takes out either one of them, and then that's when you can look to catch a reversal, okay? So that is the final form of liquidity, which I'm going to cover right now. Now, Bruno, does that make sense? Firstly?
Yeah, it makes sense, but You got to be waking up early to be catching all of that. So that feeds into our discipline thing.
Yeah,
Because
well,
you can probably wake up at like 6, analyze the high and low of the Asian session, and then wait for London
yeah.
or whenever.
Yeah. I mean, this move down here tends to happen in London. So London session is going to be around 8 a.m. So yeah, you need to wake up around, let's say, 7, but you don't need to wake up crazy early, because the move
Mm.
taking out the Asian low or Asian high liquidity is going to happen in London session, which is going to be around 8 a.m. So as long as you're on the charts around 8 a.m., that's going to be enough time for you to catch this move in the other direction. Okay,
Mm.
so yeah, I mean, that's another good question, bro. But basically, yeah, wake up around 7, 8 a.m. and then be ready for the move to happen in London session, taking out Asian low liquidity, and then you can start to consider taking a trade.
Mm.
That is the very, very start of understanding how I trade. Okay, it's understanding the Asian session liquidity model. Okay, and you guys are going to see in future videos that when we start to pair this up with, you know, more detailed confluences and build a strategy, that you are going to see insane results from what I'm about to teach you. Okay, so yeah, that's the first video on liquidity done. We've got one example here, okay, and we've also got another example right here. Okay, now I'm gonna have a couple more videos on liquidity coming out very, very soon. So these are going to be a lot more detailed than this one. They're going to be where I go on the charts and show you guys examples of this
Mm.
on the charts. Okay, so make sure you guys subscribe for that. And also, what I want you guys to do is let me know in the comments what you would like me to make a video on next. Okay, because I've got so many things I'm going to make a video on, but I want you guys to let me know what you need help with in terms of discipline or in terms of psychology, and I'll make a video on that as well. Because yes,
Mm.
understanding strategy is important, but it is also equally important that I can help you guys get out of your bad habits and actually develop your psychology and discipline to a good level. So let me know in the comments what you want help with in terms of that. And that is basically it. Make sure to subscribe so you don't miss any more videos from me, guys. And I'm going to end it there.